Today, we're diving into a really fascinating business case study. It's about a company that tried to prove a huge idea that you could do good and make a ton of money at the same time. But what happens when those values collide with the cold, hard demands of Wall Street? For Salesforce, this wasn't just some catchy slogan they slapped on a billboard. This was their foundational strategy, the very DNA of a multi-billion-dollar empire. But recently, that foundation got a serious shakeup, forcing a decision that put their entire identity to the test.
Okay, so let's get into it. To really understand what was at stake here, we have to go way back to when the company started in 1999, because this is where they decided who they were going to be.
Right from day one, Salesforce rolled out something called the 1-1-1 model. And look, this wasn't just some side project for charity. No, this was a core business strategy. The whole idea was to attract the best talent, people who wanted their work to mean something, and to build this incredibly loyal culture they called Ohana, which, as you might know, is Hawaiian for family. The model itself, it's actually beautifully simple, built on just 3 pillars. They pledged 1% of their company equity, 1% of their actual software, and 1% of their employees' time. The impact, though, well, that was anything but small. So let's talk numbers. That 1% of equity, it's translated into over $700 million in grants. Think about that. That's a massive financial commitment baked right into the company's structure from the very beginning.
And, it wasn't just about the money. That 1% time pledge led to a staggering 8.7 million hours of employee volunteering. This was the real human engine behind that Ohana culture, right? Getting people out there, making a difference together.
And this is where it gets really smart. This is that third pillar in action. By giving their powerful software away for free or at a huge discount, they've helped over 56,000 nonprofits in schools. They were literally using their own tech as a tool for social good.
All right, so as the company got bigger and more successful, they didn't shy away from these ideals. In fact, they doubled down. By 2022, they decided to weave these values even deeper into their strategy, in a way that even Wall Street would have to pay attention to. And here's the kicker. They tied executive bonuses to hitting their ESG targets. That's environmental, social, and governance goals. All of a sudden, things like sustainability and diversity weren't just nice ideas. They directly affected how much the top brass got paid.
And this had real, tangible results. The company hit net zero emissions across its whole value chain. And they used their massive influence to push their own suppliers to set their own climate goals. This was proof that they were walking the walk. But this is where our story takes a turn. What happens when a company built on these amazing people-first ideals runs headfirst into a wall of financial trouble? Well, the ultimate stress test was about to begin. The first crack in the armor was a slowdown. That incredible growth that had fueled them for decades, it started to sputter. And the market, which had always rewarded them for that growth, started getting really, really nervous. And that nervousness, it opened the door for outsiders. Activist investors started snapping up stock, and they were loud. They publicly slammed Salesforce for being bloated and demanded huge changes to put profits above everything else. So, with all this intense pressure coming from Wall Street, CEO Marc Benioff found himself backed into a corner. And he made a decision that was as difficult as it was dramatic, one that would completely redefine what the company stood for. It seems subtle, but the company's entire philosophy changed basically overnight. The old mantra, growth at all costs, was out. The new one, profitable growth. It's just one word, but the shift it caused inside the company was absolutely seismic. And here's where it really hurt. The pivot led to 8,000 employees being laid off. That's about 10% of the global workforce. The Ohana, the family they had spent 2 decades building, suddenly felt a lot smaller and a lot less secure. So how did the CEO justify it? Well, he was pragmatic. He basically said, look, to protect our mission for the long haul, to help our customers, our communities, anyone, we first have to be a healthy, solvent company. We have to survive Wall Street's pressure now. In a way, it was a sharp pivot away from stakeholder capitalism back towards shareholder primacy, because as he saw it, keeping the mission alive meant putting financial health first. And what did the market think? Well, the reaction was immediate. Wall Street absolutely loved it. After the layoffs and the new focus on profit, Salesforce's stock shot up nearly 90% in 2023.
And if you just look at the financials, you can't argue with it. The pivot was a huge success. Operating margins ballooned to over 30%, generating a massive $10.2 billion in free cash flow. The company was leaner, meaner, and more profitable than ever.
So all of this leaves us right here with a huge question mark. You've got a culture built on incredible values, a crisis that threatened to sink the whole ship, a really painful decision, and then a wildly successful financial outcome. And this brings us to the core dilemma of this whole story. So I really want you to think about this. Did Salesforce betray its foundational values? Did they turn their back on the Ohana culture just to please investors and pump up their stock price? Or do you see it the other way? Was this incredibly tough decision actually the most responsible thing the leadership could have done? Was it a painful but necessary move to make sure the company would be strong enough to keep its mission going for another 20 years? I mean, it really boils down to two arguments, right? On one hand, you could say the Ohana was just a nice story that disappeared the second profits were on the line. On the other, you could argue that profitability is the oxygen a company needs. Without it, the mission, the values, everything just suffocates. What do you think? The decision is yours.